Hi there. Thanks for tuning in. Today we're going to be doing an analysis and valuation of the Estee Lauder group of companies. So let's get started, and I'm going to start with what has happened lately, and that is that the stock fell about 24%, and that happened because of their earnings report. A lot of it has to do with the fact that they bet all on China and having a lot of growth in China. That did not materialize. There's many reasons for that. One of them is the fact that the Chinese economy hasn't been performing as well as one would expect, but they've also operationally not been doing that great. So then you look at this and you say, hey, could this be the case of a company that now fell so much that it's cheap? I mean, it was trading at the mid 80s, now it's in the mid 60s. Could this company actually be worth picking up, worth doing something with at this point? And even looking at the long picture, holy cow. I mean, compared to that 24% we saw, losing almost 70% of your money in the past 5 years, if you've held this for the long term, that sucks. And I mean, that's one of the reasons why I don't always necessarily recommend buying an index because when an index fund, for example, or an ETF has companies like these in it, well, sure, their performance is made up by other companies that definitely don't perform like this, but really, you could just have a basket of companies that don't include companies like this or don't include companies where this happens? So the market cap we're dealing with right now is 23 billion. The P/E ratio is non-existent, and the dividend yield is about 2.18% with that given price. Now let's talk about why. I want the lesson from this video to be why did the price decline that much and why is it deserved or undeserved? And spoiler alert, it's kind of deserved. I mean, we're looking at the last 10 years where the sales kind of went up and then went back down, but net income in general, they weren't able to keep growing net income consistently. They weren't able to keep growing free cash flow consistently either. You have this sort of, uh, I guess, top of a sphere shape. With the net debt, you have net debt that was actually fairly low in its time, and now it's pretty freaking large. I mean, the picture here is one of a company that the financials just all declined at the same time in these past 2 years, and you have more debt, so you have more obligations, so you have less net income because of that interest. So it's something to really know, to really look at. And I think that makes the decline justified. If you look at the revenue growth here also, you have these years with good revenue growth, 4.5%, 5%, 15%, 8%, followed by declines here and there. 2020, sure, everything declined, no problem. Then you have the stratospheric rise as people buy a lot of stuff, and then this decline as people stop buying a lot of stuff. And the problem here is when you look at the gross margins and the operating margins, they weren't able to capitalize on that and build stronger margins. You start with a gross margin of 80%, which means that they keep 80% of whatever unit they make, you know? And now it's 70%. I mean, that 10% decline is significant. This operating margin, they were improving it almost to 20%. Now it's 10%. So your marketing costs, your salaries, everything there, your SG&A, your research and development, that all is now taking a toll because it's taking a larger chunk out of everything. The earnings per share growth, I don't really care about that number, but it's really just not been stellar. The dividend growth is not really that present anymore because they cut it, and we'll see that. But then all of these numbers here, return on assets, return on equity, return on investment capital, which is the most important part because it shows you how much you get in return for making new investments, for making more growth. And this number, while it used to be 20%, and they've recaptured that number here and there, it's now a meager 2.4%. So not a great picture here. And if you look even shares outstanding, you would see that they were buying back slowly but surely, and now it's sort of plateaued a little bit in these last 3 years. And actually, they're issuing a tiny bit more shares now, which makes sense because they need to raise money from somewhere. So, and the dividend history. Here you see they cut the dividend almost by half. It's actually really sad because, of course, the stock price is going to go down because sure they can't afford the dividend is probably the right move, but investors are not going to like it. So you have this like quadruple whammy of things that make the stock price go down. So we're going to value it. So what I'm going to do is I'm going to estimate the revenue going forward, and I'm going to just use Yahoo Finance and the analysts for that. And the lowest estimate here says this coming year they're going to have $14.09 billion. And then the year after that, $13.65 billion. I'm valuing kind of a doomsday scenario, not really. I mean, it's a little bit of a revenue shrink, but not that much. And we're talking from a point of $15.6 billion being the revenue from before. I think this makes sense. I mean, you have tariffs on China from the US and vice versa. You have the fact that operationally they're not as efficient as before. You have the fact that they are struggling, that they have more debt to service, etc. So, and even then you may be a little more shy towards growth opportunities, and that also means less revenue in general. So I think this is realistic, honestly. And I want to be conservative, so I want to see what those numbers give me. Now, those revenue numbers, I'm gonna say 7% of that gets turned to actual net income. The reason why is because, or to free cash flow. The reason why is because generally they average about 9%, and now it's been 7%. I'm going to say, okay, let's keep it at that, right? Because operationally they're getting a little worse. So 7% of revenue gets turned to free cash flow. Now, what we're going to roll with is those two numbers, 7% of those two numbers for 2025 and 2026. And then we're going to grow the company by 3% for 2027, 2028, and in perpetuity. My required rate of return is 11%. That's 1% more per year than the market in the long term. And that adds up to be a lot more in general. Now, divided by the total number of shares out right now, I actually get a fair value of $32.38. But we are not including the net debt. And if we add back the net debt, which is about $6.7 billion, it may be a little less depending on how you count it. I know certain websites count it differently. So in general, even if it's a little less than this, well, you get a value that's significantly lower. The value I get here is $13.49 with net debt included. If you roll with a number of about $4 billion that other websites may show you, then this value is going to jump up to about 20. But looking at all the way back here, $64.26. Hello, it's not even close to the first value, which is pre-debt. So even before the crash, even assuming there was no crash in stock price and that they actually grew 5% or something like that, I wouldn't have bought this stock. It's not a deal? No. It simply doesn't look like one with a mix of the growing debt, the lower cash flow, elevated valuation, despite falling 70% from all-time highs. They still don't look like a great deal. A cut dividend and the lack of share repurchases make investors rely solely on cash flow growth. That's the only way the stock goes up now, is not because they bought back more stock, because they don't have the money to do that as much anymore. It's not because they have a reliably growing dividend, because they don't anymore, because they cut it. So this scale, you need cash flow to grow and grow a lot, hopefully. And the problem here is it isn't yet. Now, could there be a comeback story? Yeah, but know that you're taking more risk by betting on this comeback story rather than seeing evidence and seeing these margins that are slightly improving and then a really good quarter, they can knock it out of the park. I don't see this. The margins are worsening. So I would like to see proof of them improving before I could even consider jumping in. So cheap isn't value. You have a stock that's cheaper relative to where it was before, but that is not value for you. What it will give you back is not really that much compared to other opportunities. There are stocks out there that have doubled, tripled in the last couple of years, and yet you'll probably get better returns out of those than with Estee Lauder. Now, thank you so much for watching. I hope you at least got a lot out of this video and learned a few things. And in general, if you want me to look at any other companies, please comment down below. I'd love to take a look. Thank you so much, and have a great rest of your day.